Okay, I don't see him updating, but let's start it. Uh, so, what is option means? As I said, number of time now, Deep and Jeet, we already talk on it. So yeah, what is option, right? So option is a contract between two parties. So we are not buying stocks yet. We are just talking about it. We are just thinking about it, buying a stock in the future. That is what option is. We are doing a contract between two parties where one party may have stocks and one party is just thinking about the stocks. You don't have to have stocks to sell the contract. Okay, that is also little bit confusing there. Two parties are agreeing, one is going to give you the stock, one is going to buy the stock. One has the obligation and one has the choice, buying the stocks and selling means stocks, right? So right now we are not buying any stocks or not selling any stocks. We are just thinking about that. I need to buy the stock on this particular time. On this particular time looks fine. I will buy on this in the future.
Hmm.
So that is the means all about option. So that can be a stock, that can be an index, that can be any ETF, which is allowed in the stock means in the option market. So we think about, okay, this date I will buy on this particular time. I can buy ETF stocks or index, and I will hold for that much time for that contract. So this is just a contract between two parties. One is selling, one is buying the contract. Just a contract, no stocks underlying. We are doing anything about it here. This point, okay. Okay. So the second step, we are saying call and put. So what is the call option? So call option is when you think stock will go up, means you think the stock is going up, and put option is when you think when stock is going down. This is the credit side, buyer side. Okay, we are saying right now we are talking on the buyer side. So normally when you start, let's start with the buyer side. Don't try to be on the seller side. First thing means basic one or two trade, at least few trade to understand what you are doing. You should always be on the buyer side. We are paying to buy the contract. We are going to do the few first trade where you are going to pay to buy the stocks. Means pay, contract paying and buying the stocks. Now call option. What is the call option is contract that allow the option holder buyer to buy 100 stocks. So Apple is on 150 right now, 15, and I think okay, I want to buy the stocks in 2023 or next month or 6 months after. So this is my date. I am deciding first when I am going to buy the stocks. Second, what I decided, I'm going to buy 100 stocks. Third, what I decided, which price I am going to buy. So three things I am deciding that okay, this is my price of stock I'm going to buy. I'm going to buy this on this particular day, and I have to buy 100, which is contract is always for the 100 quantity of 100. So you are buying one contract means you are buying to go to buy 100 stocks. So always remember this is going to be one contract equal to 100 underlying stocks or whatever ETF or index fund means you are talking about 100 on this at the strike price to be defined expiration date, say it to be long the call. So if you think okay, what is happening, Apple is going to go up or SPY is going to go up, what I am going to do is I am going to buy a contract. I think that next 3 days Apple is going to go up. You can buy weekly contract and we in the Friday is going to expire. That contract is going to finish, but you are sure that this is going to go up. You are buying the call and you are going to hold for 3 days and then you are going to sell it, right? So that is what you are doing. That okay, this stock is going up. Then you are buying a call That is what you are doing right now. Okay. Who is the option seller then? Same person. I can buy the call, means I can buy the call, I can sell the call. So when you are selling the call, what is your responsibility? When you are buying a call, you are paying for something, your risk is only what you paid. When you are paying for something, your risk is what you paid for that contract. So you can't be losing more than that particular premium what you paid. That is the risk limit, right? When you sell the contract, so buying is a choice. Buyer has a choice to buy on that particular day, or they can leave that I don't want to buy because price is going down, and what I bought it is not going to make sure sense, so I just don't want to buy it. So buyers has a choice to buy the go means complete that contract. Call seller. Whoever is a seller has an obligation. So when I am saying, okay, I will give this phone or I will give this laptop on this particular day on this particular price, and I want you to pay me $100 right now. So I have an obligation. If I am a seller, I am contracting you that okay, you give me money, some basic money, some premium money, like an insurance. If you pay, okay, my life, I need a 200 means 100 1 million insurance, I am going to pay premium for $1,000 per year. Something happened to you, insurance company has an obligation to pay that $1 million to you or your family because they got the premium. So seller has an obligation to fulfill that contract. Buyer means nothing happened to me, insurance is done, my car is fine, or means I am fine, and I don't need that insurance next year. I have a choice, I don't go again in the contract. So buyer has a choice, seller has an obligation. So if you are selling, like I just go in the market and sell one contract for the Apple on 115, right? So $15, $115 per minute. I sell one contract. I got $2 premium for that, and I thought, okay, that stock is going down. When you are selling, what your assumption is stock is going down. Call selling. When you are selling a call, your assumption is stock is going down. So when you are selling something on a call side and you are getting premium, you are assuming that this is the highest limit, it's not go up, but stock open 130. Now you sold on 150, stock open on 150, and if call buyers say I want the stock, you have to get the stock from the market, whatever market rate. One that means 130. You have to buy that stock from the market and provide the stock to that call buyer. So call seller has an obligation. Call seller has to find the stock from the market and provide that stock to the buyer, call buyer. So very careful when you are selling the stuff, when you will. And for me, don't sell call alone. So this is a basic rule for me. Don't sell the call when you are in the market. If you are selling a call, I will show you how to sell it, but only sell is not going to help. You can't sell only calls. Okay. You can always buy a call. That's fine. No problem. If it is ghost, you will make a lot of money, but you can't sell a call only. You should very careful. So again, what is called when call buyer, when call means you think that stock is going to go up, you are going to buy a call, you are going to be long on the stocks, and you are have a choice, you are going to have a choice that okay, you will buy this particular stocks on this particular date and future. Okay. And you are paying some premium for that. So call buyer has a choice, call seller has an obligation. Simple. If you are selling anything, any contract, you need to fulfill that contract. So that is there. Now put, when you think stock is going down, right? So put buyers, only when I am talking going down, I am saying about buyers. So okay, stock is thinking that okay, this market is overvalued and this means particular stocks, I think it should go down. So when you buy a put, your assumption is means this particular stocks is going to go down, and you are going to make money when stocks goes down. Premium will go up, and you will make money. So again, here you are paying something. When you are paying money to buy something, your risk is only what you paid for that. So when you buy the contract, buy the put contract, stock goes down, you make profit. But if stock goes up, what is your risk is only that particular premium, what you paid for that particular put. That is your uh, means maximum risk. Now put seller. So if I'm selling a put, so my assumption is what? Stock will go up, and I don't have to provide that stock to this guy, this particular person. Means I don't have to buy. So put seller, now confusion. When I sell you a put, what end of the means when I buy the put, what I am trying to do is if I have a stock, 100 stock, and I bought 100 stock at 115. We are going with the Apple, $115. But tomorrow value goes down and it becomes a 95 or a 85. Now I have a put. I am buying a put at $100, and I am saying, okay, stock goes down and put expires on 90 or 85. I have 100 stocks. I will go and give it to that guy who is selling put to me. So he's going to get my 100 stock on that what put I bought it. I bought it 100 means one contract of put on 100 strike price. So I'm thinking the stock price will go down below 100. Whatever I am, wherever stock close on that particular day, I am going to make that particular profit once our contract expire. So I was having 100 stock. I bought a one put contract and stock goes 85. I am saving my stop loss. I am saving my losses from the market. Now I will give that stock, whoever selling me the put contract, who is seller, he has to buy that stock at 100 price. So, like I sold one put contract at 100 and stock close 85. I am I am going to still going to buy that stock on price of 100. I can't go and buy 85 because I sell the contract. I got the premium. Now stock price is below 100. Still I have to buy on 100 because I got the premium. So now, as a seller, put seller, my risk is downside, whatever, wherever I sell the put. So I decided 100 is a good price. It should not go below, but it goes down to 85. I am going to lose all that money and I have to buy that particular stock on 100 only. I can't buy at 85. I have to buy at 100 only because I sold that put. So any question here? Because this is little bit confusing, but once you are means clear here, you will be all right.
And no questions so far.
Okay, good. So call buying. What is your risk? Whatever you are paying the premium. Put buying. What is your risk? Whatever you are paying the premium. Call selling. Your risk is upper side. If it is stock goes up, you are having all the risk wherever stock goes up, but you have to provide that stock on that particular time. Put sellers has to buy the stock. Put seller has to buy the stock. Call seller has to give provide the stocks, right? So by because call assumption is going up, put assumption is going down. But when you do the seller side, your assumption reverse. Means when you are saying call buyer, I am buying the contract, but when you are selling the call, you are thinking stock will go down. So put buying a put and selling a call, meaning is almost same, a risk is different. Same thing, buying a call and selling a put, meaning is almost same, but risk is very different. So when you are paying anything, your risk is defined. You will have the controlled risk. When you are selling anything, your risk is not defined. Risk can go, means in the option, it can go very fast up and down. So please careful for that. But it's not that complicated. It's very easy. So the same thing, buyer and seller, who is means buyer has a right to exercise, buy or sell 100 stock, the underlying stocks, right? And we'll call it a call holder or put holder, long option. Seller, who is a seller? So seller always called a writer. Seller is writing something, is a contract writer. Have an obligation to buy, sell at the assignment 100 stock to the underline, and caller means also it's called call or put writer. So when you are saying I am holding, means you are buying a call, and when you are selling something you are writing the contract, and when you are buying it's means you are holding the contract. So the same thing, what I am saying is if you buy, if you pay with the premium, you have the choice. If you are seller, you are getting something, some money, you have obligation, same as the insurance company. Is like you are buying insurance. If you pay the premium, insurance company is obligated to pay the amount they agreed upon. Okay? Simple.
Right.
Yeah. So what is the now we are trying to, means I'm not today I'm not going to very go deep and define the option geek, because option geek get confused very fast. It's very easy normally. Don't get panic about it. It's nothing there. When we'll see, it will be automatically covered when you see the means any software. It will automatically take care of it. But we'll try to get that into the next session. So let's find what is the in the money, at the money, and out of the money options. So when stock is traded at 100 today, and I am thinking I will buy the stock in next 6 months. So what happened? I decided I am going to buy the contract, like today is November, so December, January, February, March, April, May. I am going to buy the May contract. And monthly contract, there is a monthly and weekly and quarterly contract. So depending which you are buying, but mostly all the contract is expiring on Friday. So monthly contract on third Friday of the month. So mostly we deal in the monthly contract because it's a less volatile. They means weekly contract is little bit more volatile. So we will deal in the monthly contract. First thing, we'll try to do like about 30, means minimum 30 days. For me, I am minimum 45 to 60 days. Contract should be more than that only. Means if you are targeting to buy or sell whatever you want, but your contract has to be have at least 40 to 40 50 days above, means out of. So if you are thinking today something doing something, your contract date should be at least 2 to 3 months out. Okay? So what is the in the money stands for? So when today stock is means trading at $100, and you want to buy the stocks after 6 months in a May, I want to buy in the stocks. I decided this, I will buy the stocks. What is the price I'm going to buy? So there is a number of options. When you go and try to buy the option, you can buy the stocks. It's traded 100 right now. but I can go and buy the stocks at 90, 85, 50. You pay more premium if you want to buy that price. So stock price is 100, but I am thinking, oh no, I need the stocks at $90. If stock goes down, still I am seeing the value and I am ready to pay more premium, but I will in the next 6 months the stocks will be more higher. But I am still thinking if it is 90, I will buy it and I will pay some premium. So that is called in the money. Stock price is 100. I am saying I will buy the stock at $90. So $10 difference is a in the money. In the money means current price minus some discount I am going to buy. Means I am going to under that stock. I am going to below the market price. I am going to buy. So I'm paying little bit extra premium for that. At the money. So same thing. Stock price is 100. I am going to buy at 100 next 6 months. So that called at the money contract. Out of the money. So like okay, I'm really thinking, oh, this stock is going to run fast, and I don't want to pay so much premium, but I will make still going to make money, and this stock will be above 120 on next 6 months. So it must more maybe more than 120, and I'm thinking this I should pay less premium right now. I don't have that much money in my account, and I want to pay less premium, and I am thinking it is going to be more than 120. So I will go buy this stock at 120 strike price. Stock price is 100, strike price 120. I am getting that one particular price from the market that I will buy the stock on 120. If stock close below 120, I am going to lose all my premium. But if stock goes above 120, I will make money, right? Whatever premium and then stock price. So that is called out of the money. So current price, stock price above some, I am going above that stock price. That is out of the money, not the current one. At the money, I am paying the same. I am trying to get the same price in future. That is at the money. I am trying to go under that price, which is current price, and I am trying to buy under that price. I have to pay more premium. It is going to be in the money stocks.
Hello, by one question.
Yes, sir.
So which one I mean, if we look at overall the option pricing, right?
Hmm.
So you're saying that the premium for the option would be higher if you're trying to buy in the money.
Yeah.
Is that what?
So you see my screen?
Yeah.
Yeah. So this is called option chain. You know that means I am not sure
Yeah.
Rishi,
Yeah.
you know this properly. I'm sure at least you know basic. But so this is Apple. This is option chain, right? So option chain. Now we are thinking. I want to buy in June 18, right?
Mm.
Here all the options are listed. June, I'm first thing what I'm trying to do is define the date, future date, when I want to buy the stocks, or means I want to sell the stock. So I go and option chain. First thing I am defining the date when I am going to do this. So let's pick up the 18, June 18. What is the stock price right now? So this is the call side, this is the put side. Here is the current price 115. So 117.34 closing price. So you buy 1175 or 115. 117 पे या 115 पे buy कर रहे हो. So that is like at the money price. You can buy here 115. It's kind of at the money price, right? So now what is your question, Jit?
Oh, sorry, I was moved. Yeah. So when we are buying in the money, the premium, I was thinking about conceptually the premium should be less, right? Because the overall amount, because you're going to look at what's your option value corresponding to the stock price, right? So let's say in this case, 117 is your stock price, and then you're looking in the money, which is $100, right?
Yeah.
So that means your option itself has a value of $17 by default, right?
Yeah.
Because
Yeah.
right, that's what.
Yeah.
So and then whatever the premium you're paying, I believe the premium would be less, no?
Yeah. So logically, yes. If you see, right, stock price is 117. So
Mm,
if you buy 117 stock, you have to pay $12.
right.
But I'm paying $22. What I'm doing is I'm buying the stock $100. I'm paying $22. But if I sell without stock is not going anywhere, and if stock just close here after 6 months, just close
Yeah.
here, right?
Right.
So 100 and 215, 17. How much
Hmm.
dollar we are having here? $5,
Right.
right? So $5, at least I'm going to make $5 back.
Right.
At least this is intrinsic value. So
Right.
what is it saying? That you already have the value on your stock. You already making money right now. If you are buying at
Right.
100, you're
Mm,
already making $5 extra,
right.
right? And stock can go up and down. You don't have to worry. If from here stock start going up, you're already making money from $100,
Hmm.
right? 100 to 160, it close on 200. So you, when you are selling that contract, your contract will start from the 100. So you will make money from here only, $100. If you buy that stock that particular day, you will get it at 100, and right now stock price is 200. So that is your intrinsic value. This is all, you already having the value. You are paying
Right.
that value
Right.
in advance.
Yes, but okay, well,
Yeah, yeah. So that's the idea. Like, yes, the option itself has a value,
Yeah.
and buying in the money, that means you're not paying for the speculation a lot compared to buying out of the money when you pay for the
Yes.
speculation, right?
Yes, correct. So we are paying intrinsic value right now, means we are already going under the money. You are paying some extra money, which is extra, is not extra real, which is
Hmm.
you are paying this already
Right,
making
right,
money, right?
right,
Which is
right,
in
right.
the money, so you are paying this difference here. You are making more value of your options, and when you go under the money, when in the money, your delta. Now, if you know little bit, your delta move,
Hmm.
means showing your value move $1. Okay, if stock price goes to $1 up, your option price will be up by 75 every day. Okay, so it start making more money. If you go at the money, you make only $54. If you go 150 or $120, right? So you start making less money. If you go out of the money and stock goes up, you will make money, but you make less money if you go out of the and you pay less premium, but you make less money.
Mm.
If you are in the money option, you are paying little bit extra premium because of this intrinsic value,
Right, right.
and you are getting more value out of it because you are going to make more money. But the same time, if goes down up, you are going to, if it is closing below 100, you are going to lose this money also, right? But that
Yeah.
is all we, that's why we have to learn the technical. And when we are buying a long term, we go in the money and we making sure that okay, little bit in the money, not that much, but we'll make sure that okay, this is going to be like how much money we are going to make, and this is my support. So we try to find the stocks last support, good support, and try to buy there, and making sure that it will bounce back. So we, our portfolio will not volatile too much. Okay.
Okay. Thanks.
So mostly always having like if you buy too long, you say 70 delta is good delta it called, and if you selling something 30 or less delta is a good. But that's
So
next topic.
yeah, probably my next question would be would be for the next topic, but I don't know whether right now is a good time to ask. The thing is with the in the money, and you're saying like we should not really go deep in the money, right? So what's the percent threshold, like how deep we are allowed to go
So
safely?
say around 70 delta to 75 delta is a good thing. Means it's not that bad. But going up way under the money is you are paying more right now, right?
Mhm.
You have to pay more from your pocket.
Right.
If you go under the whatever, you can go and buy at 180. You already make the profit like 180 to 115, 117 already
Mhm.
there, but you have to pay more from your pocket. So
Oh,
sometime you have to decide that should I invest so much into the one stock, or should I just invest means normally as the statistic 70 to
mhm.
75 is a good in the money stocks. So enough at my portfolio 5% or 10% maximum money I am going to invest in this stock, and I will hold for that particular time, right?
Okay.
So a good statistic as per this testy work guys have that statistic. So they say that means more than 45 days out, and if you buy around 75 or 80, 75 to 70 delta is a good. So and selling side is 30 or less delta is good. So stock may not go to the 30 or 30 delta in 45 days, right? That is what they are saying. So they're back testing saying. So
Okay.
we will buy like 70, 75 in between, buy the stock when if you are going to hold for like 1 year, 2 years, those contract, that is enough because it's 1900. 19 means 1900 you are investing here. Right? So
Mhm.
that's
Okay.
why. Okay. So a long, so exercise and assignment, right? So when you are buying, you get assigned. So that is kind of risk, but it's not a risk. Uh, Stocks, if you buy a contract, there is always an option. Means somebody is a seller, see he is going to have a lot of loss. He can ask for us early assignment, exercising assignment. It called assignment. And if you are having like stock is going too much in the end of the contract, you get assignment, right? So that will be to risk which you need. Your portfolio may need that much amount in that portfolio, or you will have the margin account which assigned one stock assigned you can sell next day. It's not big deal.
Okay,
But
so that's interesting. Sorry to interrupt, but yeah, this one I wasn't 100% sure. So that's a good thing to know here. You're saying if I just buy a call option,
mhm.
even in that case as well, I would get the assignment. Like,
Yeah, you can, depending on
but
intrinsic and extrinsic
but
value.
but yeah, but that's the thing, right? With the call option, you said I'm not obligated, right?
Yeah.
So if I'm not obligated by doing the assignment, you're making me obligated to buy those, right?
Yes. So that's means if stock is going up in your way, right? But you can't get assigned under the value. So you will assign only if stock is above the value.
Okay.
So it's not like you buy 100 contract and it goes to 90 and it will get assigned to you, or you have to sell him, or you sell something. You will not be making loss in. But that contract and seller side, they see, okay, dividend is coming, and means mostly time value. There is an intrinsic and extrinsic value is there, right? So time
Right.
value means if you buy out of the money, and there is a some value assigned to that particular time, means itna time period hai, and I'm going to uh, have that much time. People has to see the value in the contract. When value is gone, they will start panicking and they try to get out of the contract. So that's why we need, means if you are going for long time, you should be more than, means that's why we are saying more than 3 months at least. So you have that time period in favor, and that will make sure nobody is getting assigned here. But if you go weekly call, you may get more assignment because call is expiring today and I don't want to hold it, and tomorrow it may go 50 cent down. I see that, and I will ask for assignment to my means. I try to exercise that call. Okay, so let's
Okay.
try to understand means how to see this
Okay.
long option get exercised. So in the after end of the contract, if your contract is in the money, if you don't do anything, right? In American contract, you can buy today option and you can sell tomorrow the same thing to somebody else. You don't have to hold for entire time. So if you buy that contract and it finish the time, means it entire you hold that entire time period, and you bought at 100, it's right now stock price is 150. You get us exercise that contract. In the end of the contract, you get that 100 stock at 100 price. You pay the price, person give you the stocks, and contract is over. That is normal contract will work. So exercise the call when option holder opt to buy the underlying at strike price, typically 100. So you are opt to buy, end of the contract, you see the value. If it is 90.99, you are not going to buy because you are still saving 1 cent. You are not going to buy. But that contract is 101 or 100.5. You are making 50 cent. You are trying to buy that contract and sell in the market instead of leaving away, right? So if your stock close above 1 cent from your strike price, from your contractual price, you will assign that stock. If you are a buyer, you will get that stock automatically. If it is under 1 cent, you will not get that stock. So end of the day, you have to decide you want to hold that option till end, or you can get out of the option before it. Exercising a put is when your option holder opt to sell the underlying at the strike price, typically 100 strike. So now I sold the contract, and whoever is buying that put contract, because stock is going down, 100 stock is now $85, and he is giving me that stock as 100. If I am a seller, I am a writer, I have to buy that stock particular $100, and I have to pay 100 at that stock price is $100, not the $85. So the put writer, right? If the option has intrinsic value of at least 0.01 at the expiration, it will be automatically exercised. So if I bought $100 call, and if it is right now a stock price is 100.01, I am going to get that. So you have to make sure that if you don't want to buy that, you have to sell that particular option and get out of it. If you don't have that much money in your portfolio, because you know they will have that, means you will get that stock, but they will charge you some interest, means your account, because you don't have that money. So in the end of the contract, you have to make sure that you know what you are going to do with that contract. So if your account cannot support the position that will create by auto exercise, you should close the option position, right? That is what I'm saying. Okay. What is assignment? Assignment of call is option writer fulfill their obligation to sell their share at the strike price, typically 100 shares. Short option can be assigned at any time. assignment of a put is option writer fulfill their obligation to. This is all assignment is all writers buy their stake at strike price. That is put one. So put has to be buy on upper side means if I bought my put at 100, stock is 85, but option writer who bought sell the put, he has to buy it. He or she has to buy the 100 stock at particular strike price. So that is assignment. As option seller, you do not choose if when assignment will occur. The option buyer control this assignment happen when they choose to exercise their options. So now put as a put, there is a two thing. So if you bought a put, you have 100 stock, you want to exercise your option, you can give that stock away. You don't want to sell the put. Instead, if you want to, you can go in a software and ask for assignment. So you can get rid of your stock to and assign that stock to that person. That person has to buy that stock on that particular put price. Mostly nobody means normally if you have long term call or put, nobody will do that. But if you have weekly or like 2 3 days, people do that. So be careful if you are very short term. If you are long term, if you are out of means in the money, way in the money, or you are way out of the money, it will not happen. That's the easy way to remember. Short sold option can be assigned at any time, even if you has no intrinsic value. If you use the previous Apple example, what would exercise of a call looks like? If you exercise your long Apple call, you would purchase 100 stock at 120, 100 into 120. So you have to pay 12,000. Remember, you may many people use option to leverage if you have 10 of those contract. So if you buy one contract, you have 10 into means 100. You have to be remember that okay, one if you buy 10 contract, you need to that much money to buy or fulfill that contract. Otherwise, you will get charged like interest rate. Your account will broker will charge you interest rate once you have to pay. So you always remember one contract is 100 stocks when you are dealing with an assignment and exercise, because that happened with Amazon. Amazon assigned one side of assignment, so that was too much money. If you use the same example, what would assignment looks like? So if you were assigned a call, would need to deliver 100 stock if you are seller side, right? Apple, and you would receive 120 per stock. So 120 का contract था, 100 का 12,000 का obligation था. But if you don't have a stock and now stock price is 130 or 140, you have to go buy that stock on that particular price and give back that uh, stock to the person who bought it on 120. So that will be your loss straight away. So very careful. Same thing here. I'm trying to more okay. So
So,
I was hoping that this will be the today's thing, because I was not going to go into the delta vega and geo theta. Not complex thing. डराने के लिए नहीं जाना. Yeah, sure.
so you're saying you got the assignment for Amazon or someone else got
I
the
got the
assignment?
assignment, but I was
Oh,
having the sell side also. You can't just go and buy the contract in Amazon.
hmm.
So yeah,
So you actually had both sides.
yeah. Big stock. You will go for both side, right? We can't afford the premium. If I just want to buy the call, I need like a 74,000 for buying a call, which is not going to happen. 40,000 call in future of out of the money also. So I have to
Hmm.
sell something against it.
So okay, so
That I
this
will show you next
okay.
class, where means whatever I do always has a both the side most of the time. 80-90% Harsha and Navdeep is knowing that. They
Right.
are my colleague. Jeet is my Google buddy. Harsha Saibaj buddy.
Cybers buddy, yes.
Yeah. Hey Harsha, busy man.
Hey, Mayur, sorry, I lost track of time. So I saw a message at 12:40.
No worries, man. We recorded most of the session, and this means for all until here, you three all knowing everything. So I don't see any problem with that. I was means we are going to talk about option geek, uh, but as you know, means option geek doesn't matter once you go both the side. Once you start buying and selling, option geek will balance it out itself, because you are on the both the side. You are not going to lose much money over there on the having a volatility higher or delta higher. Stock price goes up and down, both the side always save you. So not big profits, but expectation is not 20%, more than 20% Jeet, right? If you are making 20% is more than enough.
Oh yeah.
Yeah.
Oh yeah, more than. Yeah, that's good enough.
Yeah.
Right.
But Navdeep and Harsha will say no.
Look, my
Jeet,
thing is, so here's the thing. I don't want to put $100
mm,
and then get $20 out, because
mm,
that $20 is not gonna give me anything,
yes. But
right?
think about it.
I want to put like, let's say 50,000 or something,
Yeah.
or 100,000. Then 20,000 is gonna give me. So
So
that
yes,
20,000 I'll be satisfied
if
as
you have
long as my.
100,000, Jeet, if you
Hmm,
have 100,000, but when you start with the 5,000 portfolio, people start with the 5,000 portfolio, right?
right,
So
right, right.
2,000, 3,000 portfolio, and they start thinking that I will make this money 50,000 in a year, and they lose everything because the expectation, wrong
Right,
expectation, right?
right.
Yeah. If you means see percentage, always play with the percentage, not with the amount.
No, no, no. I get that. I'm saying I'm happy with even 15% if I get, as
So
long as my
our
capital is
target is
also preserved.
50% per year, man.
All right.
50% per year. That is the target.
Yeah, but keep in mind, options are very volatile. Like
Yeah.
the at the same rate, you can also lose the money. So just be mindful of
Right.
that. So
Yeah.
if you
So
are
Harsha,
investing
Jeet is
$50,000 and expecting $10,000 to $20,000, you should expect to lose the same amount if something goes wrong. Be prepared for that.
so Harsha.
yeah. So
He is in a finance industry. Jeet is.
Okay. Oh, okay.
no,
He's
it's no, no, no. It's not about where I am. I'm saying yes. At one point we start with very small amount, right,
yeah.
to learn these things. So and then whatever the gain happens, or whatever the money we lose, it's not going to affect like a, l- a significant amount in terms of like your financial status, right? Because we are still in the learning stage. But we want this learning stage to actually in the future become the financial income kind of thingy as well, right?
Yeah.
So if we can figure out a way that yes, as long as we get 20%, but that 20% is kind of safe, then that 20% is very good, right? Because I'm gonna put a lot of money, and then my money, as long as my money is also safe and getting like 10, 15 or 20%, I'm very, very much happy,
Yeah.
right?
So
So
yes, we have the means for that achieving that we have certain rules. Jeet. We don't
mhm,
put 100% in the market. Never. Always
right.
50%. We have the 50% cash. Means
Mm,
most of the time. So market is volatility, full of volatility, and option give you more than 50%. Means some 20% is easiest money to get in uh, option market. But because of this volatility, because of this uncertainty, we don't want to put 100% in the market at the same time. And what is the experience is saying? So if you go for long-term calls and your goal is not 100% or 200% or 500% per year, your goal is like genuine goal 15 to 20%, that is easy to make. If you lose in certain time of that year, but you can go recover with your 50% remaining amount, you will recover that thing
Right.
with
Yeah.
adding our technical analyst uh, skill set. So once you start reading the candlestick, right, and
Mhm.
with that candlestick, if you start doing candlestick with the options, you figure it out the direction of the next few days, you can make 30-40% like in a few months. But
Mm.
that is really need little bit more focus. Sometimes you lose the focus, you get busy with, as we all are in the
Right.
software.
Right.
So, but yes,
Even
20% for with
yeah.
the 50% investment, not 100%, always
Right.
50% cash, you make a 20% easy money in the stock.
Right.
That is for sure.
So there's also this thing that we discuss about the technical chart, right?
Yeah,
That in previous sessions we discussed about like when the buyers are coming, when the sellers are coming, right?
correct, correct.
Uh, uh, in what I feel like, even recently in our WhatsApp group, there has been discussion like, for an example, lows, right?
Hmm.
Uh, uh, at certain point when the probably stock price was 160 or something, and then you start getting support. It's like, okay, now it's getting into a buy category, right?
Yeah.
So and then we know low as a company is good, the management is good, and all those things. So even if it's going down and then reach to 142 or something, even though we know that the sellers are still dominating, I think if we know the company is good, we should buy at 142 as well. No?
No, though you can buy it, right? But falling knife. You remember falling knife?
Mhm.
When stock going down, it can go down to any level.
Right.
So that's why we have to wait for sellers and buyers. Okay.
Mm.
That's why
Mm.
we go for technical analyst and then we see, okay, what should we do when we see the stock is falling like crazy and this stock is good. I know that stock is good, but what should I do? So then our technical knowledge will come in. We have to wait patiently because if you think you will find the bottom is not going to happen. Nobody
Right.
is perfect
Bottom,
to
we're
find
not
the
gonna
bottom.
find it. Right.
Yes,
Right.
we don't want to try to find the bottom, but when you go up, stock is going high, 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 and you see start not making new highs. This make a new highs, but you see the sellers are coming. That stuff happening. This was a big grade. Here also big grade, and it's not holding up properly. This way is coming more sellers. You
Mhm.
still not losing hope, but what happened next? Lower high, right? Stock is not able to break above and start giving you lower high. This is telling something. We know that COVID is like vaccine
Mhm.
is coming in, stock run up too much. If you go weekly chart, you see
Right.
here last when April it was 85. Now it's like 160. Okay, so
Mhm.
what is going to happen? Stock is good. It has to stay here, spend some time, or it has to come back. If it is has to go more upper side, it has to come back where we don't know. We can just guess that okay, this may be the support here, right? If you
Mhm.
see 124 to 170, it's too much. If you buy
Right.
every dip, it is not going to
Mhm.
help you. So what we are going to do? We are going to wait. We are going to wait to see the buyers comes in. What
Mhm.
that will tell. Once your red candle is broken by green candle and closed above, simple,
Mhm.
very simple logic. When your red candle closed by green candle above, buyers are finished, sellers took over. Now, whatever you lost, whatever opportunity you lost, don't
Mhm.
doesn't matter. We are not means we are not going to lose as a portfolio. We are going to go with the trend. Trend will tell us that okay, now I am uptrend. That is the time we have to go in and try to get the maximum return, not trying to get into the place where it's going down, because we don't know where it's going to hold up. We can just wait here. Okay, it's giving us a buyer coming in here. We just wait here. Once
Mhm.
buyers will show up, when you see these tail candles coming in, when you see the green candle is closing above the red candle, that time you put your bet, and that bet will be more means positive side. Then we have to hold that negative thing, right? Think about it. If you just you are long term means holder because of your company rule and
Yeah, yeah.
whatever, right?
Mm.
So think about it. You are not buying entire thing, but you see this is closing above the candle. You think, okay, this is too big, I can't handle. You see this next candle and then again closing above. You have to think this way. Okay, now seller is gone, buyer is in. If you buy here, you don't have to worry that, oh, I missed the 63. But you bought it here, you are going to hold for a year or two. You don't worry about it. You just hold it,
Mm.
right? So what we are trying to do it here, this technical side, we are just looking that buyer comes in, confirmation needed, confirmation that buyer is in. I am losing some money. I am not worried about it. I am seeing the buyer, and I will hop on with my option call for long term, and I will make some money. That
Mm.
is the and only chart is telling with all this whatever we are putting the indicator. Only thing we need buyer confirmation that buyers is in. We are good. We buy it, and here you put more money than here. If you get it here, you put less money. Simple logic, right? Because it's already run up so much and it's upside, you can't put more risk on it. You will make money, but you can't buy for like next 3 to 4 years when you buy big candle below. This when you go daily chart, you are more like a few months trader. So what you do, you see, you want to stock to come into the whole picture that okay, let's stock first close on above 50. If I buy here, simple, and I make here, it will be more than 30-40%.
Mm.
Stock must be means just moving 10% in the market, you will get like 30-40% in that stock. But that is your like focus trading. When you go weekly and you see big candles and near to this like lines, it has to be touching the line. Now if it is giving you reversal here, it's a nice 3-4 weeks like down, 1 month down, and then it will give you the good above candle. It didn't close above. See here, it is
Mhm.
not closing nicely above. So it can go down. Now it's near 20 or near 50 or near 200. This is all institution are monitoring. So that's why we just want to see that if close green, first red, close red. This is a really good volume, right? So
Mm.
when red volume comes and then volume slow down, that now nobody is selling, and then buyer's volume comes in, that time you will say, okay, this stock is buyable now. But you will lose. See, if you can buy, this might be a 65. You already lose like 87. You might be not buying it because it's already lost so much money. It's not going to go up. You think it's not good. But if you're thinking long term and it's near to any line, this line is monitored by lots of institutes. So was just buy it, have the means faith that it it will work. If you go and historically all the charts, that's why we have to go lots of charts, ask question ourselves. This happens each and every time. Just I have to take a bet, manage my risk, and go in.
Hmm.
So long term, go for bigger chart, monthly, weekly, and short term, go for a daily 4 hour chart. And I don't think doing day trading is worth it. So short term, you should be like having uptrend defined. We have a higher high, higher low, which is saying like this was the first higher high because this was the low. If you can get in here and hold, just like see that we get the trend. Now it's a real trend. So it's running away. So you just see this, okay. Now it will start showing a weakness here. If you just monitor the chart, you see the weakness. So you should
Hmm.
not be in the game that's it's showing the weakness. But that is again short term. You are long term, you should go to the long term chart. Short term guys should be going the long short term chart, but it up, up, first down, down, something not getting out. But here, double top means double bottom. You can still try. It goes up again, break the last breakout. You should be worried. You may try here short term, right? Now it's going down. What that mean? This one is higher, low, higher high, higher low,
Hmm.
lower high, higher high, lower high. You should not touch the stock for the long, not in until it break the last high. And then you can go for positive thinking that okay, now it's a high, it's broken. I can think about buying in. Simple, right? Now,
Hmm.
if you see this stock in a 1 month, how much it goes? इसमें percentage कैसे देखते हैं? Let's go here. Chart. Hey Sweda, you can raise the question. Okay, we are talking, but we are trying to get more and more question to clear it up. So in a month, means in a year, how much stock should be going up? So most of the time, it will not in the trend. It will stay there, but it will work for few months. Suddenly goes up. Suddenly goes up. That part we have to figure it out, and how that will be going to come. When you see bigger candle down, it start coming as a big candles. So
Hmm.
that time it will give you that okay, now we can go in. This is the time we should be in, and that should give you bigger profits. Right? So whenever it goes down and you see red big candle, you have to wait for a few days, and then this is a gap up. You may buy this, afraid of it, yes, but you see it close everything here. So this is the experience. You can buy this one. Few days down, coming down, and you see bigger candles here, green candles coming in. Few days, you start thinking that it's something is going on, cooking up here, because you are going and left side means looking at that. Okay, what happened here? Some buyers were really means having that buy. You just go and buy here, make some profit. But your time frame, depending on your time frame, you have to change the chart. It's not going to work if you want to hold for a year and you go and buy on daily chart. It's not going to help. You have to have a longer term view. So here,
And even for the long term, you suggest like we should have good amount of option trading in there
oh yeah,
instead
you
of
can buy
just
for option for 2 years out.
yeah. Then in that case, like even in case of Apple, right? If I'm looking for a long term, I could actually just buy the Apple stock itself and then keep it for 2-3 years,
Correct.
right? But you're
There is a
saying,
number of way I'm telling you.
mm,
If you are in the
mhm,
means people wants to buy the stock and have the dividend and everything, right?
right.
And result is coming up, and I am afraid to buy right now. That result may be bad. So I
Mm,
think if right now 117, but I think if 19 in 2 months I will get the stock at 90, it will be good for me. That's right.
mm,
If in the 2 month stock come back to 19, I am happy to buy because of this support, right? So what
mhm,
I'm going to do, I will sell the put. Sell the put means you are happy to buy at 90 the stock. So I'm selling the put at 90 in 2 months when result is getting over. If stock comes to 90, I am happy to buy the stock. I am getting paid for it.
mhm.
So you will get, you are a now option writer. You become an option writer because with that, this is the good place. Next 2 months, this stock is coming down, something happened in the market. So I will be buyer at 90. So I am getting paid for going to buy in a future the stock at my choice, my place where I like the stock price. I am getting paid for it.
Mm,
So if you are planning to buy in that stock, don't buy in the go and buy in the market. Buy in the future that okay, this I am selling the put. Selling the put means you are thinking stock will go up, but I am happy if the stock gets here and I will buy it. So you might get 200, 300 premium. What that mean? Instead of 90, $1 if you get, so its value is 89 now. So you are getting that stock at 89 on that
right.
particular day because you got the $1 premium. You are
Mm,
not paying $90, you are paying $89.
mhm.
Right? You are getting paid to buy that stock on in the future, and you are buying at your liking price.
Mm.
But only thing you have to buy there in stock if goes like 70, you still have to buy at 90.
Yeah, yeah.
Correct. But you like that price here and you think that it's okay, I am okay with that 90 if it will come back because it's a good company and I'm happy to buy that particular price. I might be buying here and losing all that money instead of I'm buying here and making some money. Okay. So there is a number of things which we can do with the option. Means we can become an option writer, option seller, and option buyer where we see and how much we have to put the risk depending on that. We can become a option buyer and seller.
Right. And there's a question came, like, do we have to put a lot of collateral to sell that book? Do we have to have a lot of
In
collateral?
amount of money. So
Yeah.
if you buy 100 stock, $99,000, right? So collateral is
Mm,
$9,000. You are not going to have collateral, more collateral over there because you are selling put. Maximum it can become zero. It can't be infinity. So that's why when I'm saying don't sell call, you can sell the put because your risk you know where. But when you sell the call is infinity. Means if some stocks goes 30-40% up in a day, it's crazy. But if it is happened to you, you don't know how much you are going to lose. But if goes like 30% down, but still you know how much maximum loss is there. You know that this is maximum is going to be zero, not infinity. So that's why means always I try to say people that because people try to sell the Tesla calls, which is crazy. But people did that, and I think should not be done. So I always tell people that okay, that is not a good idea. Selling call alone is not a good idea. You should have covered. Uh, it depends means a number of strategies. So that's the way it should be. So next time we'll go through this some geek option geek and we'll try to cover some of the strategies. But once you know option selling and option buying, call selling, call put buying, put selling, Everything else is just a logic. How you are going to define that and how you are going to put that is always number of way you can do it. But people call butterfly and covered call and spread and lot of things. But it's simple. You are selling something, you are buying something, selling put, selling buy, buying put, selling call, buying call, strike price difference. So you can make it complicated, but it's same thing. Buying and selling, call and put. That's all. And knowing your risk. Okay. Any other questions? Harsha, Navdeep?
One thing I did not understand, right? So when we buy the call option, right, in the range and out of range, right?
In the money and out of the money.
Yes, in the money and out of money, right? So
Yeah.
when we say we are buying in the money, right, and let's say we say 70, the one you sold, right, the delta of 70, right, 0.7,
Yeah.
right? How does it make a difference that we buy at 0.7? Because I am paying a lot more premium to get to that 0.70, which is pretty much the equivalent of the price difference, right?
Yes. So
So
you get
how?
more delta, right? Here, more
Yes,
delta. You
yes.
are in the money. So stock goes above, close
Mm-hmm.
here. You make more money on closing, near to closing or closing, right? Because you
Yes.
bought it 130 or $100 and
Mm-hmm.
you are making $200. So entire $1,000 you paid little bit extra that time because you are going on in the money and that is the support location might be, right?
Okay. So basically the more the premium that I will pay
Hmm.
is not, directly proportional to the amount I'm going in. So let's say from 100 to I go to, let's say the current stock price is 100
Hmm.
and I go buy the call for 70.
Okay.
So it is not going to be 3000, which is, the multiplication of 100 into 30. It should rather be, I am probably going to pay 2500 more to buy the 70 call.
So you are saying you are so you have to buy, yes, you are paying five means you are anyway you are paying if you are going at the money, you are paying $10, right?
Yes.
If you go in the money and you are
Mm-hmm.
buying at 100, like uh, okay, let's go here. We can go little further so it will show more. Yeah, let's go. So you are saying I am paying 2600 here, right?
Yes. Mm-hmm.
And I am paying, if I am buying here, I am paying 1700 here.
Yes.
So minus how much you are paying extra?
So 2640 minus
That's
17.
all right. Around 10, 9.
900.
Yeah.
Around $900.
Yeah.
Yes.
And how much already you are making in the stock? Because it's 70.
Mhm.
$7 you are already making it.
1700. Okay. Okay.
$7 you already have it on your stock
Got it.
right now, right? So you are
Got
not only paying 200 extra to get into the $100 stock, but what is going to happen? Whenever stocks moves above, means you are buying, when you are buying you always think that now stock will go up, then you are buying a call, right?
Okay.
So you
Oh,
will make 0.71 already every time it moves.
got it. Okay.
And once it start means your strike price going in, you are going to make more and more money. Because if you bought 100, think about it, like you bought it 85, that time only stock was 100 and you bought it 100. Now 71, instead of you are making 82 because your stock is going up. Once it start going up, you make more and more money onto the stock premium.
Okay. 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 I was thinking it's proportional. Okay. It's not proportional. Okay. I get it.
Right? So that's the thing. Yep. So means and volatility, like you always try to buy on support where you have more volume, so you have to see those things. And only options, when we say options, so we always go and check this thing. If volume is less, you will be in trouble if you buying and trying to sell when it's get volatile, it might be not able to sell. You get stuck. So try to be like, okay, which option want to buy? So go and check it out, the volume, how much volume per day it's traded. That is the basic thing we do when we are trading any options. Under
So
10,000 should not be
mhm.
touched.
Oh, you're saying I can buy a call option and there's no volume, and then when I want to sell it, there's no one to buy it.
Yes.
Hmm.
So somebody is selling it, but then nobody is going to buy on your recommended price. It might be way below. Means somebody will buy it, but way below, right? You make means stock is going up, but you are not making money. That kind of happens. So
So what happens in that case? I have to keep it at, at the end of it and then exercise
so
it.
you see that okay, when you are on the chart and you see something happen here, right? Here,
Hmm.
and you want to get out of that stock. So nobody's buyers here on that particular price. You will try to reduce your price and you making a means you already here but still you have to sell it here, kind of less premium. What should be like, you should be getting
Hmm.
good premium instead of you are getting way less premium for the same strike price, because nobody is ready to buy. Market maker will pay you very less. How is that decided? So you will go again here, and there is two bid and ask price. If they have too big difference here,
Hmm.
sometimes $2, $3 difference, right? If there is no volume, you will see bigger difference. If there is a volume near to the strike, difference gets lower and lower. So some of the stock will have very bad volumes, and then it will see when you are buying, you are paying way higher price than selling, you are getting way lower price. And every penny or every cent is into 100. So
Hmm.
if you are getting $1 less, you are getting $100 less.
Okay.
Yeah. So that's why volume is very important. And if you want to sell something, sell only when stock is going up. Means already have the call and you want to put the okay, my mental profit is this much. Just put the order in when stock is up. Don't try to sell on down, because premium gets volatile, goes down with very fast. But if you long term, you don't really care, it will be fine. So, yeah.
Which software you using? May I buy this one? What is
Huh?
this? Which
This is
software is this?
EOS, Thinkorswim.
Is this a paid service or is
No, it's
open?
with Thinkorswim is trader trade, right? Thinkorswim.
Oh, okay. Yeah, don't know.
So I think they bought say, your what you are using. They bought this company, or your broker also. They bought this company. Schwab bought this company, so they should have that option now.
Oh, they should. Oh, okay.
So for option chain, you need something where you see the bid, strike, and option volume, stuff like that.
Yeah, I don't see these in Charles Schwab yet.
So they must have some software somewhere, or they already
Hmm.
bought this. You can move to here, means on this software.
Hmm. Okay.
That helps. But when you talk about SPY, right?
Yeah,
Means we are talking. You go with the
most probably index. Yeah.
index. So what we are going to do? So index, same thing, no problem. Means this is for our daily and weekly. See here, same we
Hmm.
what we see over there, same thing you see here. You can buy it here. Don't worry here. You buy it here because you are buying for long term, and you just hold it. This is why I am positive now last week, because this big huge candle is closing above. Now these candles are up, so you don't put so much onto it, but still you can put 20-30% easy and just wait. This is may come here, little bit here, but it will go up, right? So you buy this candle and just hold it. It opened next week like there. It came here. It's still hanging there inside candle. It might break here and it will go up.
Okay.
So you just need to be on the near any moving average. 200 is the best. Huge. 50 middle means medium term, and 20 is short term, means is already market is on the fire and you are just trying to get into it. But we are not breaking the lower low on weekly. So market is uptrend. Once it break the lower low, market will be downtrend. Same here. It tried to go up, broke it, now it's downtrend. But market goes down very fast. It will not give you that lower low kind of scenario. Just it will be running away. So it goes down. But going up, you can see easily if you don't listen to the news and stuff. You can see easily here. That's easy. Right. So we waited here. We waited. It was like, okay, support pay. We got this candle and they had come up here. It was double top. It break it. To break this double top, it has to come up with a so huge volume and buyers has to come in. So they can break this upper top, right? Now, it's very important. It's very important to hold this thing, 350, right? Once it will give you up, it will go up, down, up, down, up, down, but it will go up. Why? Because it was hard to break this. Now it broke with nice candle. It's up. It can come back and test it, retest it, and go up. Yeah. So if they have to come back, I don't see similar means money is coming in. Whatever means news is saying, whatever they say, we don't care. Money is coming in. We know that interest rate is not going up. That money is going to into market next few years until they are not changing any policy, big huge tax or any issue. Market should be up. Short term, yes, it will be volatile. Always January will be crazy, but December will be nice. Means it should not be a big trouble. So I do a lot of like SPY also. There is a number of strategies for this, but see when big candle, huge big candle breaking, you just hold it. Same thing here. You see tails coming in. You see second tails coming in. Buyers are coming. Sellers are tired. Buy it. You goes up. You don't go in the first candle in, but you see one lower high, second same high, so double bottom goes in. You can wait here because it's coming in. You buy here and goes up. Just let it buyer comes in, means wait for it. But you see the big candles of green and reds, big candles. That's the place you should focus on. Any stock, any stock. If you are on daily, you just have to see these two in a row going up, and if it is going down, you should be out. So if start going up, just try to be in, you make money. Simple, very hard to follow. Okay, guys.
Yeah, I think that's good enough for today. We almost did 1.5 hours.
Yeah. Okay. Okay, Harsha.
Thank you.
Yep. Thanks so much, Mayur.
Thank you, Mayur. Bye.